Are you or someone you know looking to buy or sell a home? When you use a HomeGain Realtor to buy or sell a home, you can get $150. Visit HomeGain.com and click on the Promo 150 banner at the top of the page to get started. Compare HomeGain Realtors and choose your favorite. Complete your home purchase or sale transaction with a HomeGain Realtor, and HomeGain will pay you $150. Get started today by going to HomeGain.com.
Welcome back, everyone, to Real Estate 360 Live. I'm your host, Ryan Sloper, joined today by my guest, Louis Cammarosano, the general manager of HomeGain. Quick reminder, the show is dedicated to building the Washington, D.C. Metro's housing and credit markets by giving you guys good free advice. If you ever have any questions, concerns, or real estate needs, the best number to reach out to us is 877-245-2030. That's 877-245-2030. Remember, if you're in a situation where you've been trying to get a loan modification through for the last 6 months to a year, going back and forth with the bank, faxing them, 50 to 100 plus documents, and then them telling you that they didn't receive them, only to send them again and then end up denying your loan modification. And you're turning for answers. You want concrete answers of what you can do, and if there is anything that you can do. That's what we're here to do, is to help you, put you in a position to avoid foreclosure. Ultimately, foreclosure is one of the worst things that could happen to you. You want to stay on the right track to potentially be able to get back in the next 2 to 3 years where you could buy another property to take advantage of the artificially manipulated interest rates. So reach out to us. It's 877-245-2030. Before we jump into our predictions, I wanted to give you this week's Market Movers. This segment was brought to you by HomeGain. HomeGain is the place to get you started buying or selling a home, finding a realtor, and getting real estate questions answered. If you go to HomeGain.com today, you can see what I'm talking about. All you have to do is type in your home address, and you'll get an instant free estimate of your home's value online. It's a great way to monitor your home's value, and it's totally free. So check that out today. It's at HomeGain.com. So there are really not that many real economic reports of any consequences this week, other than the weekly jobless claims, which will come out on Thursday. So what that means for those of you out there that are trying to figure out where interest rates are going, most likely interest rates might trickle down a little bit. They might get a little bit better this week, only because last week with the Fed coming out and saying that they probably weren't going to continue buying all the way through 2013, they sold off. Mortgage-backed security markets sold off, and interest rates got worse. What that really means is, let's say that somebody was getting, I'm making these numbers up, 3.25, they were paying no discount points. Last Thursday when that happened, they would have been paying 0.6 discount points for that same loan. So it did change quite a bit. I do feel like the mortgage-backed security markets are very oversold at this point, and I feel like that the equity market stocks are very overbought. I think that I don't know. I think it's a farce what's going on in the equity markets. I really don't think that things are. I think it's more a lot of institutional buying. It's not your everyday Joe that's out there buying, picking stocks and buying them.
Absolutely.
These are hedge funds, retirement plans, pension plans that are buying into the market, that are riding this rally out.
Remember, you mentioned hedge funds, which means they have access to borrow money very cheaply on margin.
Yep.
To do what? Buy stocks. Well,
absolutely.
That drives the demand up, so they can buy 3 and 4 times the amount of stocks they otherwise could have bought, or even more, but because they can borrow money at low rates to buy stocks.
Yeah, and I mean, the average person will just go on to any site. I don't know, Yahoo or CNN, and they look at just, the overall. They'll see, the stock market's doing well. Everything must be going well for the stock market to be up. I don't believe that.
The average person is buying. They understand Apple. There's probably a lot of retail interest in Apple.
Sure, and Apple's doing well. Apple stores are always crowded, and there are always anomalies in the market. There's always companies that are going to thrive in different, periods of time of where we're at in the economy, whether we're in a depression, recession, or we're thriving. There's always going to be companies that are, thriving. However, overall, our employment situation is not getting better, okay? The way that they calculate the employment numbers is skewed, and it's not really telling Americans what's actually going on. We're losing jobs all over the place, and don't think that this is not going to continue. You continue to tax the rich. You're going to up taxes on the rich. They're going to find a way to make the same amount of money or more that they were making last year. Who will probably have to pay, suffer the consequences of that are these small business owners that are hiring these people. They're no longer going to hire, and they might fire people. Nobody's even talking about that, Lewis.
No,
I mean,
because what they'll do is they will make the same amount of money as last year. They'll have 2 fewer employees.
yeah, and the people, like you said, all the the subsidies that they're giving a lot of big companies, whether it's NASCAR, whether it's Goldman Sachs, whoever it is, they're the big boys that are making the real money, and they have these same tax subsidies that are kicking back in, where it's not going to affect their income anyway. So,
Same with the very wealthy who have millions and billions of dollars of assets. Most of their income comes through capital gains, and that's taxed at a far lower rate than ordinary working people who make income. And if they happen to make $400,000.
Sure. I mean, and they've got more money to play with. They can invest in the stock market. They can buy more real estate with cash. And so that's going to lead me into our predictions for 2013. Obviously, you and I just stated that we think that the Fed will keep interest rates, keep buying mortgage-backed securities to suppress mortgage interest rates for the rest of 2013. I think we're both in agreement on that, and I think even probably into 2014. Wouldn't you probably agree?
Yes.
I don't see any change coming because I don't think that
they
all of a
may
sudden
talk about it, but they're not going to change that. They cannot change that.
No.
Absent some black swan surprise they have for us. The way things stand now, they will continue.
Yeah, and the interesting thing, because a lot of our predictions are gonna kind of piggyback off of what the Fed's going to do, right? So
unfortunately, it's not based on reading the tea leaves of the market and having an understanding. It's really Fed watching.
Right. So okay, now that we've established that the Fed's going to keep keep buying mortgage-backed securities, where do you think interest rates are going to go for 2013?
Flat.
Flat. They're going to stay the same. I would tend to agree. I would say that they could edge up a bit.
Yes,
because
but they'll keep it within a range.
They'll keep it within a range. I wouldn't think that interest rates at any point would get higher than a 4% level at any point. I can't really see that happening. I think that they want to keep things moving in the real estate market. As far as the market that we have here in Washington, D.C., metro area, obviously we don't have enough supply of homes. Now, there's an oversupply in some areas, but the majority of the areas there is an undersupply of homes. The demand is super high. People are getting frustrated that they're unable to take advantage of the low interest rates, and they're missing out on multiple contract offers. Do I think that's going to change this year? No. I think we're going to continue, especially in the metropolitan areas throughout the country, but especially in the D.C. metro area, we're going to continue to see a very tight market, especially at lower price levels. There's going to be probably an increased level of competition. People are, they're starting to see that their rents have been rising up, and they're like, what can I do to get into this market? In many areas of D.C. Metro, you're able to obtain a mortgage for less than you can rent, and in many cases, a lot less. Just working with a client the other day, was trying to obtain a VA loan, and he was trying to buy a new home, and he was currently paying, somewhere around $1,500-$1,600 a month. He could buy that new home at roughly $240,000 and have a mortgage of roughly $1,100 a month. That's a VA loan with zero money down out of his pocket. The new builder was going to pay for his closing costs because that's some of the incentives that the new home builders will use, because they tend to be a little bit higher priced than your average regular sale. So his savings was a net of basically $300 a month from what he was paying in rent. I think that trend will probably continue, but here's the problem. Predictions for 2013. Lewis, do you think that banks will start to ease up their lending standards or tighten them even more?
Probably tighten them even more, and I think the only thing that's going to change our prediction, and there's some things that are likely, fairly likely, and very likely to happen, is they raise the debt ceiling and we get downgraded. That changes the dynamic. Job gains remain flat, so really no change there. However, the job unemployment numbers are skewed because most of the gains in employment are in people 55 years and older, which means that the young people are not going to be able to buy houses, and I predict the student loan default rate will go from 9% in their first 2 years to over 10%, and then after 3 years you'll have close to 15% of students defaulting. If that happens, you can have a student loan crisis, which will mean you'll put more money into them. The Fed will have to inject more money into bailout money. And then you could start to see maybe another downgrade, in which case that's where the Fed loses control of interest rates and rates start to rise as a result of either a student loan default crisis or maybe some type of overseas problem. And then the other thing that could happen is they've been talking about shale and fracking. If somehow that shows real promise, that could be a way of working us out of the woods. But again, that's the most unlikely prediction for 2013. The main thing I think is going to happen is everything's going to remain the same, except there's going to be all increased pressure on the Fed's gain. So they're going to have to continue to step on the accelerator and continue to try to print their way out of all the underlying weaknesses in the economy. And that also will be good for gold and silver, and I predict double-digit increases in the prices of both of those, with silver outpacing gold.
Yeah, I tend to agree. And you brought up an interesting point with the student loan default, the potential for even higher default rates. A reason why that is important. Okay, let's talk about people that are defaulting on their student loan, but then they still want to. They say, hey, I'd like to buy a home, but you're defaulting on your student loan. If you're trying to obtain a government loan or really any loan, good luck trying to get a mortgage when you've defaulted on a federal debt. Okay.
Well, Ryan, good luck trying to get a mortgage if you have a student loan and you don't really have a job that can pay off your student loan. How can you add a mortgage to that?
Yeah, I mean, I'm talking about people, let's just say they're doctors or dentists, right? And they've got hundreds of thousands of dollars in student loans. They've been deferred. They've been trying to enter into a practice somewhere. They couldn't do it, but they finally do. But they're behind on their student loans. You know what I mean?
Yeah.
Now they find a real job, an actual job that's paying them good money. They're still going to get hit because they've basically have defaulted on their student loan debt unless they can get caught up on that.
A lot of parents are people don't realize are on the hook for these student loans, which also harms their economic mobility.
Absolutely. So, I mean, there's a lot to think about in 2013, but I think much is going to be the same as 2012, barring any big changes from the Fed, which is not likely. We're coming up on a break, guys. When we come back, we're going to jump into some of your questions. Stay right there.